Hello students, welcome to Accounting Explained at AccountWise Academy. This is Latha Venkateshwaran. In today's video, we are going to learn about return down value method of depreciation. Topics to be covered for today's video are Introduction to return down value method or WDV method, finding rate of depreciation for WDV, problem on finding rate of depreciation, merits and demerits of WDV method. Introduction to return down value method. This method is also known as fixed percentage on declining base method or reducing installment method. These are all the other names for WDV method. Under this method, depreciation is charged at fixed rate on the reducing balance, that is cost less depreciation every year. So this I will explain to you with an example. Suppose if the cost of the machine is 10,000 and the rate of depreciation is 10%, then at the end of the first year, depreciation will be 10,000 into 10%, that is depreciation will be rupees 1000 rupees. Okay. At the end of the second year, depreciation will be charged, that is cost less depreciation, first year depreciation. What is the cost? 10,000. What is the first year depreciation? 1000. So for the next year we have to take 9,000 rupees only for calculating the depreciation at 10%. So 9,000 at 10% is 900. So second year depreciation will be 900 rupees and it goes on like this. Accordingly, amount of depreciation gradually reduces every year. See here, first year depreciation is 1000, second year depreciation is 900. So it has reduced gradually. The depreciation charge in the initial period will be very high and depreciation charge in the later period will be negligible amount. So see, as it keeps on decreasing, at the later period, maybe at the end of the 8th year or 9th year, it might be very less. Okay. We are going to see now how to find out rate of depreciation when cost of the asset and life of the asset, that is period of the asset, is given. The following formula is used for computing depreciation rate under return down value method. So R is equal to, that is rate of depreciation is equal to 1 minus S by C to the whole power 1 by N into 100, where R is the rate of depreciation, S is estimated scrap value and N is the estimated life of the asset. So scrap value is the value of the asset you get when you are going to sell that asset at the end of the life of the asset. Suppose the life of the asset is 10 years and you are going to sell the asset at the end of 10 years, for how much it is going to fetch you. That is the scrap value. Let us see a question on how to find out the rate of depreciation. Okay, the question is as follows. From the following information, you are required to calculate depreciation rate under WDV method. Cost of the machine is 10,000, estimated useful life is 3 years and estimated scrap or salvage value is 1000. This is the question which we saw just now. See, scrap value or salvage value both are same. In the exam, if they ask you or give you salvage or scrap, both are same. Okay. So the formula we just saw, no, R is equal to 1 minus S by C the whole power 1 by N into 100. Where here N is equal to what? N is 3 years. See, estimated useful life is 3 years. N is equal to 3. S is 1000 rupees. Scrap value is 1000 rupees. And cost of the asset C is, cost of the machine C is 10,000 rupees. Let us substitute this in the formula. R is equal to 1 minus S by C. So R is equal to 1 minus S is 1000 by 10,000 to the whole power 1 by N. To the whole power N is 3, 1 by 3 into 100. Why we are multiplying by 100? Because we are going to find out the rate of depreciation in percentage. Rate of depreciation, rate will usually be only in percentage. Okay, that is why we are multiplying by 100. So 1000 by 10,000 is 0.1. 1 minus 0.1 to the power of 1 by 3 into 100. 0.1 to the power of 1 by 3 is 0.464. 1 minus 0.464 into 100 is, first we are going to deduct 1 minus 0.64. It is 0.536 into 100. It is 53.6%. So the amount of depreciation is equal to cost of the machine into rate of depreciation. What is the cost of the machine? It is 10,000 rupees. 10,000 into 53.6 is 5,360 rupees is the total amount of depreciation which we are going to take for the lifetime of the asset, that is for 3 years. This is the total amount of depreciation for 3 years. That is the lifetime of the particular machine. Okay. Merits of WDV method. This method is accepted by income tax authorities. If your business is going to follow WDV method, then that method is accepted by the income tax authorities. Impact of obsolescence will be reduced at minimum level. Same example we will take. What was the cost of the machine when we bought? It was 10,000 rupees. First year, at the rate of 10% depreciation, we charged, the depreciation came to 1,000 rupees. So the cost of the machine or the book value of the asset came to 9,000 rupees, and the second year depreciation was 900 and book value of the asset became 8,100. Similarly, it was going on. First year itself we have reduced the cost of the machine drastically and it has come to the value of 9,000 at the end of the first year, the asset value. And second year also it has come to 8,900. Like this, initial year itself we have returned out the value of the asset to a larger extent. So if you are going to change the machine, or if the machine has become obsolete at the end of 6th year, the book value of the asset would have reduced drastically. Okay. So the impact of obsolescence will be very low, or it will be minimal. Okay. Fresh calculation is not required when additions are made. Suppose if you are going to make some addition to the machinery, or you are buying some same machinery for 1,000 rupees at the end of second year, then it is not necessary to have the calculation from first year. It is easier because we can start from the end of the second year onwards itself. See, second year book value was 8,100, right? Plus 1,000. So at the end of the second year, the rate of third year, that is rate of depreciation, will be only 910 rupees. That is 9,100 at the rate of 10%. So it's very easy to calculate when there are additions. Under this method, depreciation amount is gradually decreasing. Is it not gradually decreasing? 1,000, 8,100, like that. And it will affect the smoothing out of profit, periodic profit. Initial years, our profit would have reduced drastically. But when we go further down the line, that is for the 4th year or 5th year, our profits will be set off. That is what smoothing out of periodic profit means. Okay. Demerits of WDV. Residual value of the asset cannot be correctly estimated. What will be the final value of the asset? That is very difficult to calculate while we use the WDV method. It ignores the interest on investment on opportunity cost, which will lead to difficulty while determining the rate of depreciation. This 10,000 rupees which we use for buying the machinery, if we had used that 10,000 instead of buying the machinery for some investment, you have invested that in some investment. Okay, this is for investment, you have not bought the machinery, and this investment fetches you 8% interest. This is the opportunity cost. The cost which we are going to forego, that is 8% interest, 800 rupees, which we are going to forego by investing in 10,000 rupees asset by buying machinery. That is the opportunity cost. This opportunity cost the rate of depreciation does not take into account. We saw the formula for rate of depreciation. No, what was it? S1 minus S by C, scrap value divided by the cost of machine, to the whole power 1 by n into 100. There is no scrap opportunity cost here, right? So totally ignores the opportunity cost, the interest on investment which we are going to get by investing that amount somewhere else instead of investing in the machinery. It is difficult to ascertain the true profit because revenue contribution of the asset are not constant. See, the machinery, suppose it can produce 1000 units per year of some thing. Okay, this machinery which you have bought, it's going to fetch you 1000 units every year. But so in a year the sales would have been lesser, or the production would have been lesser because the demand is lesser. You would have produced only 700 units. Okay, so in some other year the demand will be 1100 units, but this machinery can produce only 1000 units. So the demand is higher, you can produce only 1000 units. So it is not easy to calculate or it is difficult to calculate the true profit because revenue contribution of the asset are not constant, because it depends on the what demand outside for your product. Okay, the original cost of the asset cannot be brought down to zero under WDV method. This is a very big disadvantage of the WDV method, because the original cost of the asset can never become zero when you follow WDV method. If you would like to inquire about the online classes which I take, or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.